Hello, everybody. Welcome to the DeFi Pulse Open Forum. We are here with Hugh and Brave from Nexus Mutual, Jonah, as well as David. Welcome, everybody. And I'll say, let's just wait 1 or 2 minutes so that we have listeners dropping in. I know that it's not easy to catch the exact moment when a presentation starts, so I want to give people maybe 2 minutes, if that's okay. I think we're slowly there. I'd say we get things started. Welcome, everybody. We waited for a little while so that people had a chance to tune in. Welcome to DeFi Pulse Open Forum. This is our space to explore the latest trends, key developments, and market insights in decentralized finance. We will also share updates from Nexus Mutual, where we're building a decentralized, viable alternative to traditional insurance through a risk sharing infrastructure. This is an open forum session, which means we are joined by guests from the DeFi and Risk Learning Group, which is a peer to peer network of finance, risk, and technology professionals diving deep into the foundations of DeFi together. On call with me today are Jonah, David from the DeFi and Risk Learning Group, Brave New DeFi, who is leading product and risk at Nexus Mutual, and Hugh, the founder of Nexus Mutual. Again, welcome everyone, and welcome to all our listeners. Okay, we have a great mix on the agenda today. We'll have fresh insights from the market at the State of DeFi section with Brave, and then we'll have the latest updates from the team at Nexus Mutual from Hugh, and then we will have an open forum discussion where we answer each other's questions, where Jonah and David will also join us with their thoughts and questions, and I'm excited for it. And today we're trying out something new as well, which is a mini quiz. This is our first live quiz attempt, so fingers crossed that it all works smoothly. It's going to recap part of what we went over in the last presentation with Brave, where he talked about decentralized exchanges. Last but not least, Brave will continue his DeFi landscape series, today focusing on stablecoins, their characteristics, risk profiles, and more. It's a great opportunity to refresh your knowledge on the DeFi fundamentals today with stablecoins. Okay, Brave, the stage is yours. Tell us about the state of DeFi these days.
Thanks, Sam. Good afternoon, everybody. It's been a little over a month since our last DeFi Pulse call. Since then, ETH has gone up 54% in price, and we've seen a little bit of life return to crypto markets as worries about tariffs have eased slightly. Crypto markets are still largely correlated to movements in traditional markets. I closely benchmark moves in crypto markets to movements that happen in tech stocks, albeit with a lot more volatility in Bitcoin, ETH, and other alts. So let's see how this broader shift in the market has impacted the on-chain benchmark yields. Since Aave currently dominates the lending market yields with 67% of all on-chain loans issued, I'll use Aave's core market on Ethereum for standard USD rates going forward. Aave's Ethereum market currently offers lenders 3.9% APY for lending stables, with an average monthly yield of 2.87% APY for USDC. USDC rates on Aave have been trending up over the last month as ETH has increased in price, signaling a renewed demand for leverage with, again, signs of life returning to the broader market. Rates in Aave markets on Ethereum Layer 2 networks are slightly higher, but all markets tend to converge to the same base interest rate over time as traders conduct arbitrage between those markets. ETH staking yields remain largely unchanged, as ETH staking yield is on average consistently in the 2.9 to 3% range. The current benchmark yield for ETH is the average ETH staking yield, and that's holding around 2.95%. So overall, ETH's jump in price has flipped traders from bearish to lukewarm bullish, as the average annual funding rate rose from 0.33% from the last time we spoke to 8.78% today. There's broader optimism in the market, but no real narrative that's driving these price movements as everyone waits for the economic impact of tariff discussions and trade war talks to settle. For now, the market is a little less fearful and looking more optimistic. Comparing this, though, to U.S. Treasury yields, while on-chain benchmark yields are nominally up since our last call, they still haven't flipped the rates provided by short-term U.S. Treasury bonds and the secured overnight financing rate. So as long as TradFi players can earn higher yields off-chain, it's unlikely we see new money flow into DeFi markets. To see a revival in DeFi markets, we're going to need to see benchmark rates and broader yield opportunities on-chain flip U.S. Treasury rates by at least 2 to 3%. So we'll need to see the on-chain benchmark rate grow about 3 to 4% from here before that happens. But while benchmark rates still need room to grow, there are still several yield opportunities that are well above the benchmark rate for both USD and ETH strategies. So let's talk about several of those briefly. The EtherFi liquid market neutral USD vaults. That's on Ethereum. It's currently offering 12.6% APY in addition to some points, which are convertible to tokens at a later date. That vault accepts USDC and different stablecoin deposits, and then those get deployed into an underlying strategy that's run within the Veda vault that is used for that vault strategy. So it'll go into lending markets like Morpho and Aave. Some of it might be LP'd on Uniswap or Balancer. And the Veda team basically runs a strategy and is able to create market neutral strategies that yield higher than average yields. So right now that's sitting about 8%, 8 to 9% above the benchmark rate for USD. Another option is the Go USDC Beefy Vault. For that vault, you can deposit stables in, and they'll be converted into Go and USDC and put into a Balancer V3 pool and then staked on Aura. When we talked about DEXs on the last DeFi Risk Learning Group, we talked about Balancer and Aura. Aura is like a boosting protocol, so there are token incentives given out on Balancer. And if you stake your LP tokens on Aura, because there's a bunch of staked VE BAL there, that boosts the amount of BAL token incentives that you're getting, and that is what allows you to get a higher APY. So if you go on the base network on Beefy, you can find this yield opportunity. The average 30-day APY here is 11.7%, and the current APY for this vault right now is about 17% as of today. Stake level USD, or the token's name is SLVL USD. Level money. This is a stablecoin that's backed by collateral that is also made up of different stablecoins that are deposited in the lending markets. And again, this money is basically put into Aave, Morpho, Compound, these underlying markets where it can earn higher yields and is moved around so it can optimize yields for depositors. And stake level USD itself is earning protocol revenue. So protocol revenue in level money is directed to staked level USD stakers. And those folks are earning 9.45% APY plus points that can be converted to tokens at a later date, and then opportunities on Ethereum. Then, of course, there is the Sky Savings Rate, which of all of these strategies is the lowest risk. The Sky Savings Rate is provided by Sky Protocol, and the yield here is actually coming from short-term US Treasuries. This flows back into a vault, and for those who stake their USDS, which is a stable coin, you can mint in Sky Protocol. If you stake that as SUSDS, you can earn 4.5% APY. So just a little bit above the benchmark yields rate, but this is also slightly higher than you could earn just by holding US Treasuries natively. And you can actually take advantage of the Sky Savings Rate on Ethereum, Base, or Arbitrum. So for the USD yields, those are some selections. All of them are good. We have cover for all of them at Nexus. Looking at the standout ETH yields, again, EtherFi's liquid ETH yield vault is one of the highest earning opportunities. 7.5% APY plus points that can be converted to tokens at a later date. That opportunity is on Ethereum. Same thing here. There is an underlying strategy that's run by the beta team in a beta vault, and those funds are allocated to different lending markets and different yield opportunities that are ETH-based, and that's what's generating the yield in that vault. Then there is the Euler base WETH market. Euler is a permissionless lending protocol with different markets. This one is one of the Euler governed markets. The APY here is 6.21% over the last 7 days. And this is made up of supply rates for lenders as well as some token incentives. And this opportunity is on base. And then the Compound V3 WETH market on Optimism. Compound is interesting where they don't have as many assets as, say, Aave or Morpho that can be accepted as yield-bearing assets, but WETH and USDC are ones that you can use as collateral and you can both earn on as well. So the APY over the last 7 days in this market has been 3.71%. So all of these are above the benchmark rate for ETH. Some are slightly higher and some are significantly higher than the standard ETH staking rates. And that is kind of the look at standout ETH yields. Like I said, broadly speaking, we're not seeing yields that were as high as they were, let's say, 6 to 8 months ago, but that is because the market has kind of cooled with the current macroeconomic climate. But as things change, I think we can expect to see yields increase, but we're kind of in a sideways crab market. So the double-digit or triple-digit yield opportunities are out there, but they involve quite a bit of risk. So to see more of those return to kind of baseline, safer to moderate risk protocols, I think we're going to need to see kind of a shift in the market and an increased demand for leverage to power some of these yields, as most of these yields come from lending protocols. And with that, I'm going to hand things over to Hugh to give some team updates. Hugh?
Cool. Thanks, Brave. Yeah, I guess a few things going on, but perhaps more generally, I guess the way I see the kind of DeFi markets at the moment is, I guess the first DeFi stuff has really been like grassroots driven and like retail driven, and like a whole bunch of people just getting involved. And it's shifted over the years into like many more opportunities and complexity, and it's shifted to, I guess, a more institutional / business focus where the big players, the big funds are kind of dominating TVL and I guess the deployment of assets. And then you've got retail who's probably like entirely confused because there's just so much going on and too many opportunities and not quite sure exactly what to do. And so they probably don't do much. But then you've got other businesses or other protocols kind of jumping in, trying to create like vaults or smooth like opportunities where it's kind of managed on your behalf and that type of stuff. So I guess in that context, Nexus's kind of main customers are really going to be either the big funds that are kind of allocating stuff or that kind of the businesses or those intermediaries that kind of making it easy for the end consumer and kind of talking to them. So I guess from a strategic level, that's really what we're going to be focusing on more in terms of what we build and what protocol enhancements and stuff we put together. I'm going to come out with over the next couple of weeks, hopefully, when I get a bit more time. I'll come out with a bigger update and share on the forum, and I'm very interested in getting some feedback on that and from the wider Nexus community and see where things are going to go. But in terms of I guess more specific stuff that the team's been working on now, very recently, in the last couple of weeks, we shipped some cover, the ability to edit cover and put in limit orders at the smart contract level. You can't do that right now easily in our UI. We haven't shipped the UI yet, but that's work. It's a work in progress at the moment. It's almost there. Just trying to iron out the last few bits. But that's pretty cool because one of the things that people haven't been able to do easily is edit their cover. They buy a certain amount of cover and then halfway through, or maybe they shift protocols or whatever, or they increase the amount or decrease the amount. You'll be able to do that now and get credit for the remaining cover that you haven't used yet. So that's pretty cool. And then also limit orders is an interesting one. It really kind of enables some cool functionality, including the ability to kind of renew on a monthly basis. Not necessarily intuitive by the name limit orders, but it kind of is a general tool that we can use for a whole bunch of really cool things from a UI perspective. So keep an eye out for that when we ship it to the UI. I guess one thing kind of worth mentioning is kind of in line with the institutional business focus as well. But we've decided to put layer 2 work on the back burner for now. We were seriously considering shipping that this year, but the Ethereum kind of community more broadly has had a bit of a change in strategic focus as well, and there's definitely an increased willingness to scale the L1, and so given that most of our protocol, most of our cover buyers or users are really at buying, I guess, higher net worth type stuff, the gas cost is less of an issue unless it gets really bad. And so the priority of us putting work on L2 is a bit lower now, especially given we have more confidence that we won't end up with these long-term gas spikes at triple digit numbers or even high double digits. So I guess we'll see how that goes, but that's kind of what we're looking at now. And we're instead focusing on protocol enhancements that effectively allow teams to build on us, other protocols to make use of this a lot better. And one of the things we are exploring in a lot of detail is the ability to work with insurance companies to sell regulated cover on the Nexus Mutual protocol. And so that's there's a few details about how you actually do that, etc., and how it's possible. But we're working on that quite deeply, and we think we've obviously get some more feedback from regulators and all the rest of it. So it's not exactly a quick process, but we've made significant progress on that over the past few months. So we're going to be looking at that piece. And I guess the other thing that is a bit of a is coming soon, but we are working on, and I guess it's quite topical at the moment, is we're working on a kidnap and ransom product. And I mean, hopefully you may have seen some of the news about kidnaps in Paris and other places in France recently, the more high profile ones. But we kind of think that this is a real issue for people that hold crypto, and we want to be able to provide some essentially protection. And I think one thing that people don't realize about this product is it's less about, oh, here, have some money if something happens. It's more about, here, you have access to a dedicated response team to help you through the crisis situation. And so I think that's really really kind of needed, a useful product. And so we're looking to provide a crypto-enabled version of this specifically for the quirks that happen that occur with crypto coverage. So so if you're interested in that, please reach out, and we can put your name on the early access list that we're pulling together at the moment, and we can be in touch as soon as we've got something to get out there. Unfortunately, it's a it's a really tough one. Obviously, we don't want this to happen at all, but having this type of coverage, I think, is kind of really valuable, especially the fact that it's not just monetary; it's actually support during the event, which I think is really useful. So yeah, keep an eye out for that one. Lots more other smaller stuff going on, but I just wanted to highlight the big points. So those are the that's where we're at from the team side. Happy to take questions a bit later or now, depending how you want to do it, Sam. But happy to answer anything on that as we go. Thanks.
Thanks, you. Thanks, Brave. If anybody has any questions, please feel free to share them wherever you are watching us. I can see that there are some viewers on X as well as on YouTube. We'll address them shortly. Okay, let's dive into the open forum. I'll begin by recapping our progress with the DeFi Risk Learning Group, highlighting key ideas from our recent readings about DeFi fundamentals, and hope to kick off the group discussion with some questions that were already submitted on the forum. We'll take the questions as we receive them in the comments section, but also our guests today, David and Jonah, are welcome to ask away every and any burning question here as well. Okay, to catch everyone up, in our last session, we began a deep dive into core areas of DeFi led by Brave New DeFi, who is with us on the call today. Like I said, he is leading product and risk at Nexus Mutual and has extensive knowledge in both architecture and risk in DeFi. He also provided a great deep dive into decentralized insurance, highlighting how Nexus Mutual works. If you haven't had the chance to view the recording yet, you can find the session and all previous sessions as well on the forum at forum.nexusmutual.io, and you can search for recordings there. On May 7th, Brave presented decentralized exchanges and lending borrowing protocols. Today, we will move on to stablecoins, and in a future session, we will explore yield farming. If there's another sector you'd like us to dive deeper into together, please let us know. We'd be happy to do our research and start up a discussion within our learning group. I think one important takeaway from our exploration has been these DeFi sectors didn't just pop up, they evolved. We can trace a path from basic financial tools like payments to far more complex risk reward mechanisms that are now reshaping how markets function. Brave's presentation also drew a very sharp contrast with traditional finance or TradFi, which frankly often seems far less capable by comparison, but there are other challenges that I hope we'll get to talk about today and in the rest of our sessions. I also found it very interesting to hear about the DeFi blue chips. I know that some people have heard the term for the first time because I got some questions. These are the protocols that have been stress tested both in terms of security and market conditions. And in our analysis together, we try to talk about risks in a way that is clear and accessible, and also talk about how these platforms have overcome those risks. Okay, so if you missed Brave's earlier session, again, I highly recommend checking out the 7 May recording. You can find it easily by searching for recordings on the forum. Before I kick off the discussion, a few more things that I want to talk about. The full learning group curriculum is also available on the forum. Thanks to everyone who shared their feedback so far. Personally, I'm excited not just to understand the depth of DeFi together and explore it together, but I think it's also interesting to understand the barriers to adoption, and also explore what makes the space difficult to access for many. And I think spaces like these provide great opportunities to really pin down what the issue is. To support this, we try to design a cohort that goes until mid-July with a lot of theory, a lot of practice, and guest speakers as well. We are currently welcoming 3 to 5 new participants. So if you are on the wait list, expect an email from me this week. As we learn about all this and get to know the ecosystem, I think it's probably interesting to understand what the next steps for the participants might look like. We're building a peer-led structure for the group, which I will get to soon. We hope that these cohorts are co-led by an organizing circle that reads together, continues to understand DeFi together. Also very, very excited about the blockchain risk working group that we are co-leading with OpenCover, where we will be inviting a few cohort members to join to map out the risk in blockchain, which I think is crucial for us to have more adoption of DeFi and stay safer in DeFi. Okay. So, if you're on the waitlist, expect an email from me soon. This is some more general description about the learning group. If you have a background in risk management, underwriting, insurance, we have 3 to 5 new openings. Please apply at nexusmutual.io/risk group. I'll be sharing some more links and invites on our socials over the next couple of weeks as well. Okay, finally. So this week we read together with Jonah and David, who are also here on the call with us today. How I'd like to do it is I will present the 2 readings that we read together and just talk about some of the general themes mentioned in the reading in case you haven't had the chance to read it. By the way, you can find the reading links on the forum as well. And invite Hugh, Brave, and all the others to chip in with their thoughts whenever they want. But I'd like to see how we can discuss freely in this section. So let me recap this real quick. I think it's a really nice piece by Phenomedics, which I know Brave quite likes as well. It's a historical piece. It has been published almost 4 years ago, so we need to probably rewrite a version of it. I don't know, maybe a member of the learning group or maybe members will write it together. But this article outlines critical ideas and architectures that have shaped DeFi, like the user-to-contract model that made Uniswap's pooled liquidity possible, or how Synthetic's liquidity mining program catalyzed DeFi summer in 2020. We also see how read about the different projects like Maker, Compound, and Yearn taking unique approaches to governance and token incentives, shaping very different outcomes. Before we move on into the discussion, Hugh, I'd love to hear your thoughts. You have been around very long. How do you reflect on those early days and early experiments of DeFi? And what do you think has changed the most since then?
I think in general we're speed running the history of the history of finance on chain, but with some interesting additions as we go along. I think to me one of the biggest step changes was the user to contract model rather than peer to peer. So peer to peer has like been in theory something that works, but never been able to execute. Like you can look at a whole bunch of traditional finance peer-to-peer approaches, and they all end up at peer to some big pool on the other side. And I think I think that's one of the really cool things that the smart contracts can enable. And then obviously you strap on liquidity incentive programs and bootstrapping new protocols and fundraising type thing. It's very similar to like ICOs and also in like a new way of doing something new, bootstrapping and stuff. So there's a lot of similarities there, but just done in a different way. But I think in general, the way I think we're doing stuff is we're speedrunning all the cool stuff, adding some awesome extra bits as we go along the way, but also falling down a few holds that we probably shouldn't have fallen down because they've been done before. And if people just looked at like the history of finance, they probably would have seen that. But every generation has to make their own mistakes, I guess. So I think that's kind of my very general high level stuff. There's so many, I kind of love looking at the history of the stuff, but I think it's one thing that you can learn a lot from. And if you do want to get into some of the details, there's some really interesting stories if you look them up, etc. Some of the things I say to my friends that aren't involved in crypto, they're like, really, this is just mind blowing when you kind of go through it. But yeah, so I always find this stuff fascinating, especially when you're going through it, but also to look back on it and think with kind of fresh eyes. So yeah, lots of things going on, I guess.
Thanks, you. Yeah, I also think that there are some very interesting experiments happening every day, and I'm very happy to be in this space. David, I know that you have picked this piece as your focus. I wonder what resonated with you in this piece, what you have found most interesting, but also I know that you have been around for some time as well. So, anything you'd like to share about how you think the history of DeFi will turn into or translate into the future of DeFi?
Yeah, hi. Yeah, it was very happy to read this piece. It was a nice reminder also about the course from Brave New DeFi last 2 weeks ago, where he laid out the different protocols, but not in the historical way. And here we have the historical path. And so I had two main interests. One was DeFi on Bitcoin. So it's still not really there, but starting to emerge since 2021, the time of this piece. So I wanted to maybe have some thoughts about that. And the other thing that they mentioned at the end of the article is for the various types of lending protocols, lending and borrowing protocols. Most of the loans are, from what I know, are over-collateralized. So you trust that the loan is always going to be over-collateralized, otherwise it's going to be liquidated and you're going to get your money. And people are still thinking. I read a tweet earlier about from the founder of Morpho of under-collateralized or no collateralized loans, where the trust comes not from an automatic algorithm, but from either a social profile, let's say, social score, or from off-chain collateral such as a house. And now also we start to see tokenized things with RWAs and so on. So I think he's thinking on that. But yes. So my second point here was this: what's your thoughts on the under-collateralized or no collateralized loans? Yeah.
Thank you, David. Very interesting. We received another question. I received it per mail, asking the same thing about over-collateralization. So I guess we'll get to it later. But I'd like to first invite us to think about DeFi and Bitcoin. Brave or Jonah or Hugh, any thoughts? What do you think will happen? There have been some developments, right?
Yeah, definitely. I can go first. Yeah, there has been like an emergence of DeFi and Bitcoin. I think people have been trying to do things with varying levels of success over the last couple of years, but kind of with the restaking wave that took off, that was kind of like a catalyst for a lot of people building and seeing more success in the Bitcoin ecosystem. So there are lending protocols in some of these like Bitcoin sidechain networks. You've got DEXs, but things operate a little bit differently than they do on Ethereum, where I guess the closest comparison would be how Polygon's proof of stake network works as a sidechain to Ethereum. And for those that don't understand what that means, when we talk about like an Ethereum layer 2 network, it's built on top of the Ethereum network, whereas a sidechain is similar but separate and communicates through a bridge back and forth. And that's how most of these Bitcoin networks work, where they're a sidechain and they handle settlement on the actual Bitcoin network, but they're still communicating through this bridge because they're not like a comparable L2 in the same way that you see it on Ethereum and Ethereum L2s. But that being said, I think one thing for everybody, if you're not aware of this, but the catalyst for Ethereum was originally a project called Colored Coins that was built on top of the Bitcoin network. And when Vitalik got involved, he was basically helping them figure out how to do Bitcoin on DeFi on Bitcoin, on the Bitcoin network. And he's like, well, we could build something better that's programmable, that has this entire layer that you could build applications on top. And everybody went, da-da, we don't want to do that. And then that's how Ethereum itself was born. So the Bitcoin network itself doesn't have the functionality to have smart contracts. So when you're looking at DeFi on Bitcoin right now, a lot of it is just like multi-sigs and time releases. So it's a little bit more rudimentary is not the right word, but I guess it works. It's a little bit more rudimentary versus how smart contracts work on Ethereum or EVM compatible networks. But it's really encouraging to see such progress because there's a significant amount of capital in the Bitcoin ecosystem. And now I'll let somebody else talk on the topic and kind of give their thoughts.
I suppose I could talk a bit. So I've been doing a bit of research around Babylon, and they've got they're doing around Bitcoin staking. And so with the Taproot upgrade with Bitcoin, it added quite a few different capabilities. And there's some way you can like vote your Bitcoin with certain like parameters around it. And I don't know the technicals around it too much, but they're using a system where you can lock your Bitcoin up and then you can get keys and then use that like the locked up value to then use the capital on other chains, so that if you misbehave, then they can like slash you, which is quite interesting. Yeah. So like it's very new, so I don't understand it really well, but there's lots with the new Bitcoin upgrades which do come out. There's lots of innovation there, so I do find it a very interesting space. Yeah.
Yeah, as Brave said, that's kind of like the restaking layer. So you kind of you can build a restaking system like like in theory, like you could actually build an insurance type system on top of that, where you go like, oh, what's the slashing condition if a claim's paid, and then you could slash that Bitcoin, but you could give it rewards in the if everything goes well, they get the rewards. If things go badly, you get slashed and you lose your principal. So, but you can do that type of setup for various different things. Insurance is one thing, but like running a program is another thing of any program. And maybe if you run that program wrong, then you get slashed, etc. So it's kind of a restaking layer. It's a little bit more centralized because it's got the multi-sig layer at the bottom on the Bitcoin chain with the time locks and stuff. But I think one of the really big things that Bitcoin has going for it is the capital base in Bitcoin is huge. And there's not many opportunities to earn any material yield on your Bitcoin at the moment. And so if DeFi pops off on Bitcoin and there are reasonable yields out there, then it can and probably will attract large capital flows pretty quickly. So I guess we're kind of waiting to see what that happens. At the moment, these restaking things have been bootstrapped just because they've got points or early tokens to attract the initial liquidity because they need to do that, and that makes total sense. But then it's going to be interesting to see how it plays out in terms of okay, how useful is that? What systems are being built on top of that? Where does the real yield come from on a sustainable basis? And where does the ecosystem get built out? And so we're kind of at that initial phase, and we're going to see where it goes. It's easy to bootstrap points. It's harder to build the ecosystem with real people using it for real stuff. So, I'm sure there's going to be a few failures, but hopefully we're also going to see a few successes as well.
Do you think we'll have any Bitcoin core upgrades that introduce more capabilities around DeFi? Is that a focus, do you think?
I'm not as heavily involved in that. I know that any protocol upgrade on Bitcoin is very contentious.
Yeah.
I think there's one going on at the moment, which is basically allowing you to put more data into transactions or something like that. And I think that gives you some level of extra flexibility on what you can do. It's not going to get you to EVM type level of scripting and capability, but it may be able to give you a lot more capability to build different systems. And so, it's kind of a different risk reward trade-off. You're kind of relying on a bit of a centralized point. It's essentially the multi-sig or the consortium about minting the SBTC or the Babylon BTC on the different chain, and then you can use that within DeFi. But underlying, it's backed by one BTC in a time lock. And it's kind of like you kind of have to work out if that's okay from a risk perspective, depending on what you want to do. I think it's a relatively safe model as long as those multi-sigs don't get breached, and some of them are very big multi-sigs set up in a very good way. Others perhaps a little bit less so, but hopefully we see the ecosystem develop and this becomes okay.
I have also seen that Darknet is working on building an L2 for both Bitcoin and Ethereum, and for that they need the OPCAT code on Bitcoin to be introduced. And this OPCAT code was actually there in 2017, I think, and was removed from Bitcoin for security reasons. So I don't know if it's going to be introduced or not. But yes, Darknet is doing a lot of communication about that. We'll see, I guess.
I think, broadly speaking, my view is I don't think there's going to be upgrades to the core network that unlocks greater capabilities for smart contracts. It's still probably going to be like the layer on top strategy that we're kind of seeing. And going back to the Babylon thing, the whole idea behind that is that you can stake your Bitcoin on the Bitcoin network and then pass the security of the Bitcoin network onto other layer 2 type solutions that are built on top that have more smart contract functionality. So I think that's kind of the trend that we're going to continue to see for a while. And I think it's unlikely that there's big core upgrades to the Bitcoin network, because that would result in a hard fork, because some people would say we don't want that complexity. That's my view.
Yeah, I suppose it's not really necessary if you can use these workarounds. Yeah.
Cool. Thanks, everybody. We have quite a few other questions, so I suggest we move forward, if that's okay. On this piece specifically, I thought Jonah's question fit really well. Jonah, thanks for asking this, by the way. So I guess the question is, Oracle manipulation, liquidation failure, governance attacks, and smart contract hacks. In what order would you rank these in frequency and severity when it comes to risk? Hard one.
Yeah, that's a good one. I'll give it a crack first. Brave, you can come in after. I think probably Oracle manipulation first, then either liquidation failure or smart contract hacks second. I'm not quite sure on those two, and then governance attacks last in terms of frequency and severity. I guess it has changed over time. Like the smart contract hacks was definitely the first one, and then Oracle manipulation came in after that and kind of dominated a bit. But that's kind of how I see them. The Oracle manipulation, yeah, I guess all of them can result in full to zero type attacks, full loss. Historically, the Oracle manipulation has probably been the biggest one that causes that. I'm guessing there a little, but yeah, I think that they can all result in full loss. We haven't really seen a whole heap of governance attacks. There's definitely been a few, and they have taken all the money, or large chunks of it, which have been really interesting, but none on the kind of bigger protocols. So that's definitely on the lower end.
Yeah, so my view is smart contract hacks apply to all protocols. And so if you're going to talk about like the greatest risk for any protocol, it's smart contract hacks. But the largest use case for DeFi and on-chain markets is lending. And Oracle manipulation and liquidation failure are very specific to lending. But since they're the largest protocols, those two things can lead to the greatest amount of damage. And I think that's kind of what we've seen. So while smart contract hacks are probably the most prevalent across all protocols, Oracle manipulation has been one of the leading causes of loss over the course of DeFi from, let's say, like 2020 onward. And there's been more things, but when we didn't talk about this, so I'll mention this and I could say we can follow up and talk about what flash loans are later, but flash loans are essentially atomic loans where you can get a lot of money, but it has to be programmatic so it can be paid back within the same block. So think about a loan that lasts for 20 to 30 seconds that has to have conditions where it gets paid back and you pay a slight fee. Because people were able to use large amounts of capital, they were able to manipulate oracles that people thought were robust in 2020 and 2021. People have mitigated against that, but now there's new kinds of oracle risks. So I think oracle risk is number one, liquidation failure, smart contract hacks, probably tied for number two, and then governance attacks at the bottom. I agree with you. They're not as prevalent. They can cause a lot of damage, but people have a lot of safeguards against those, especially with like Governor Bravo and Governor Alpha, which are two very standard and popular governance models.
Okay, thank you. I would also just say, sorry, with the Oracle manipulation, do you think is that if that's the biggest risk out of those, is something being done to try and improve that?
Yeah, so broadly speaking, with oracles, a lot of the risks that we saw early on, people mitigate against. A lot of the pitfalls that we see where there are different attacks is because of faulty oracle configuration. So similar to like having a logic error or a math error in your smart contracts that can be exploited. That's one leading cause of loss for oracle failure. For oracle manipulation, having like a robust source of like price feeds that you're sourcing pricing information from is the best thing. But because people want to get loans against more exotic collateral, they use different kinds of oracles, like fixed rate oracles, which are manually updated. Anything that's manually updated runs the risk of having somebody update the wrong information. This happened recently with term finance. And then that adds a new layer of risk. So fixed rate oracles weren't used back in 2020 and 2021. They're being used now in morpho markets and some other larger markets. So this is a new risk that people have to protect against. Then you've got things like hard-coded oracles, which are hard-coded to a certain price. So it might be a stable coin that's hard-coded to $1 because there's not a lot of liquidity, but you can redeem that for the underlying collateral. So if that token depegs and it's hard-coded to $1, it's not going to get liquidated because the oracle thinks this is worth $1 because smart contracts don't know the price of things. So as people mitigate certain risks, new risks always crop up because people want different functionality. So the answer is yes, people are mitigating against some of them, but we're also introducing new ones because people want to get loans against exotic types of collateral.
Okay, thanks.
All right. Thanks, everybody. Moving on to our second reading this week. I think this is one of my favorites when it comes to DeFi fundamentals readings. It is DeFi Across 4 Primitives by Justine Humanansky. She identifies 4 core market drivers in DeFi: liquidity, leverage, risk, and arbitrage. It's a very rich piece, historical, architectural, and highly analytical as well. To give a few examples in how she identifies the 4 market movers and talks about how they evolved in DeFi. Under liquidity, she notes how newer protocols solve the inefficiency of locked up capital that plagued earlier designs. So this was mostly solved in V2s and V3s across DeFi, was her observation. And also another, I'm not going to go through all the bullet points here, but she also highlights how protocols are now offering more nuanced options when it comes to tolerating risk preferences. I think that's also a great observation and kind of like a nice trend that is shaping DeFi these days. So before I come to David's and another participant's over collateralization question, which I think is quite interesting, I want to ask Brave. Brave, what do you think is driving these innovations? And what should DeFi enthusiasts and learners also look for as they evaluate whether a protocol is actually innovating or not?
That's a good question. How to tell if a protocol is innovating or not? I think what I tend to see is the most innovation happens in lending. So it's what people actually want to do with their capital on chain. There are some common things like, like you talked about, improving access to liquidity. There are different ways of doing this. The one that everybody wants to solve is like omni-chain liquidity, where you can have one liquidity pool that's shared across every chain. That's a very complex one to solve. So there are some different ways to look for innovation. Typically, when someone's publishing white papers, when they're kind of blazing the trail in their industry, and you can usually tell when they're doing that. Like one example would be Fluid. They launched a lending protocol combined with a DEX, which is not something that somebody had done before. This is innovative. Typically, you'll hear people talking about what's innovative about a protocol. If you see something that is a fork of another protocol, it is probably not very innovative. It probably just has a token strapped to it for incentives and otherwise isn't very novel. But I think right now you can look to a lot of leaders in lending to see innovation happening, whether that's Euler, Morpho, Aave, or some people that are exploring like the under collateralized lending, like Maple or Wildcat, and some others as well. But it's hard to give a concrete answer on how to define whether somebody is being innovative or not. I would say it comes down to, do you see discussion about that protocol popping up often in your feed and online in different places? It's a good indicator.
Anybody else that wants to share their thoughts before I move on to our second question? So yeah, over collateralization. It's a hard word to pronounce and probably also hard to implement. What's the practical use case? Traditionally, when you borrow, you lack funds. Here, you already need more than what you're borrowing, which seems counterintuitive, was one of the questions that I received. David previously also shared some alternative designs that he thought might work and had read about. Who would like to tackle this? Why do we need over collateralization?
I'll give it a go. I would argue that pretty much all loans, ignoring DeFi, just think about traditional finance, pretty much all loans are over collateralized. If you think about it, if you get a home loan, you don't own a house to start with, but the after position is you put a deposit in, then you get a house legally that is yours with a covenant with a bank who's got it, subject to the loan being repaid. And so the loan is actually over collateralized by the house. The same thing with a car loan. Obviously, there's uncollateralized loans, but in terms of like the volume of loans that are out there in traditional markets, nearly all of them are over collateralized. And maybe some of them are over collateralized by the fact that you've got a job and there's a legal agreement that they can go after you and you've got future income. So I don't think the question should be, it's about over collateralization. I actually think the way I think about this is over collateralization is actually the norm. It's just that we haven't been able to like tokenize the collateral because it's a bit weird. It's not standard. It's like, oh, the house is a specific house or whatever, and all the rest of it. It's a specific asset, and on your future income is actually a specific asset to you, etc. But so the way I think about this is we shouldn't be looking to develop under collateralized loans. We should be looking to tokenize everything and then collateralize that. Use that as the collateral. So you tokenize the house as an NFT or whatever, then you borrow against that on chain, and it's still treated as an over collateralized loan. Or you tokenize someone's reputation, and you can argue, is that under collateralized or not? Yeah, I totally get that. But you tokenize that, or it's got some legal backing on it, that etc. That there's some recourse there, and so I actually think the model should be tokenize the things that we haven't tokenized yet to bring it on chain, and use that within the over collateralized model. That's the way I think it is. That we should be tokenize everything from a real world asset point of view.
Thanks, you. Any other thoughts, David? Any more comments you'd like to share here?
Yeah, I was gonna share the article from the CEO of Morpho where he talks about trust, and because yes, the loans come from the collateral of the on-chain alternative coin, or could come from a tokenized item off-chain. But small loans can also be among friends, or if you loan to someone who has a high profile on social and is completely discredited, it's kind of linked to your job, more or less. I don't know, but yeah, it can be very complicated for you afterwards. But yeah, this idea of if you loan to some friends or to someone that you know someone through some kind of mean, it's also interesting. I will share the article. But, yeah.
Thanks, David. Please feel free to share it. I'd be happy to. And I see that Coin Angel is commenting on X that they would like to share it as well. So one last question, and I think we'll have to wrap up this call. Some of the items are going to be the themes of our next call in 2 weeks. I'm sorry about that. I wasn't able to plan accordingly, but so last question for today. From CoinAngel, could we use NFTs as collaterals, and what are some best platforms to allow this?
Yeah, you can. There are some platforms out there. I can't say I know of any that, like there was one called NFT Perp, but I believe they recently announced that they were shutting down. There's not a lot of protocols that allow you to use NFT as collateral just because it's hard to liquidate NFTs. So they're not as reliable as a collateral as something that's, say, like an ERC20 token or something that has a lot more like liquidity that's available. And pricing NFTs is also very difficult. There are platforms like Pwn, PWN. It's kind of like a peer-to-peer lending site, and you can put up multiple things. You can put up NFTs as collateral, but you then basically need to go out and match with somebody that is going to provide you a loan for your collateral. So there are some platforms out there that just haven't seen a lot of success because it's very difficult to use NFTs as collateral since they're very hard to liquidate. And that's led with some in the past up to bad debt and having a hard time attracting lending capital.
Thanks, Brave. And thanks, CoinAngel, for the question. Okay, a very big thank you to all our listeners today and our panelists, David and Jonah. It was great to have you. You have really enriched the call and made the conversation very interesting. And also, as always, thank you, Hugh and Brave, for joining us as our experts today. And I hope to see you in 2 weeks. Take care and stay safe in DeFi. Bye.
Bye, thank
Bye,
you.
everybody.
Bye-bye.